for this week, we need to cover chapter 8. Okay, so chapter 7 we covered already last week. So let's close that. Go to chapter 8, master budgeting. And go all the way to exercise and do some of those exercises, which will be your homework anyway. And it will help you to manage it much more smoothly. In exercise 8-1, says the silver company makes a product that is very popular. Therefore, sales peak on May of each year. As shown in the company's sales budget for the second quarter given below, budgeted sales will be 300,000 units in April, $300,000 in April, $500,000 in May, $200,000 in June. And from past experience, the company has learned that 20% of month sales are collected in month of sale. Another 70% is collected the month following sale, and the remaining 10% are collected in the second month following sale. Bad debts are negligible and can be ignored. February sales totaled $230,000, and March sales totaled $260,000. Required. Using Schedule 1 as your guide, prepare a schedule of expected cash collection from sales by month and in total for the second quarter. What is the accounts receivable balance on June 30th at the end of the quarter? Okay, I have the solution for you here. Remember, in February, the 10% of it will be collected. So that will be $23,000 of February sale will be collected in April, 2 months later. In March, whatever you sold, 70% will be collected in April and 10% the month after. So it's March sales. In April, whatever you sell, normally you collect 20% right away, 70% in May, and 10% in June. Okay. Whatever you sell in May, you collect 20% in May, 70% in June, and 10% in July, which is not important at this point. You just keep it as accounts receivable. So in month of June, whatever you sell, 10% of that, in month of May, whatever you sell, 10% will be collected in July, 20% in May, 70% in June, 10% in July. So keep that 10% in your mind, okay? Which is right there. Just take a note. You see, 10% in July. So at the end of June, there is 10% of May sales still accounts receivable. Let's go to June. In June, whatever you sell, 20% you will collect. But the 70% and 10% will be collected later on. So that's 80% will be collected later on. That's accounts receivable. So total accounts receivable at the end of quarter, June, is $210,000. Total cash collection for April, just add them up. For May, add them up again. For June, add them. And if you add April, May, and June, it will end up to be total cash collection of $1,021,000. Make sense? Okay. Let's do number 2. In homework problem number 2, which is exercise 2, you will have a company that has budgeted sales of its popular boomerang for the next 4 months as follows. April, 50,000 units, May, 75,000 units estimated, June, 90,000 units estimated, and July, 80,000. The company is now in the process of preparing a production budget for the second quarter. January, February, March is the first quarter. April, May, June is the second quarter. Past experience has shown that the end of the month inventory level must equal to 10% of the following month's unit sales. So end of each month, you need to have at least 10% of next month's sales as a safety, right? The inventory at the end of March was 5,000 units, which makes sense. You don't need someone to tell you that, because I could have easily say at the end of March, I have 5,000 units because 10% of April is 50,000 times 10%, that's 5,000. So even if this problem doesn't tell me this, still I can easily assume what is my March ending inventory, 5,000 units. Okay, using Schedule 2 as your guide, prepare production budget by the month and in total for the second quarter. So since we have the budgeted sales data, now we can understand what is the production budget. So production budget will never exist if you don't know what is your budgeted sales. Okay, here we go. So we know the budgeted sales is 50,000 units in April, and May 75, and June 90. And we need also to have 10% of May in April as an end inventory, 10% of June in May as an end inventory, and 10% of July in June as an end inventory. So that's 8,000. So how many units total you need? 57,500 for April. However, you know that there is 5,000 already existing in the inventory from end of March. So 57,500 minus 5,000 end inventory at the end of March, it gives us 52,500 units that you need to produce. So you need to know what the production is. And for April is 52,500. You do the same thing for May and for June. But when you add them up for the quarter, remember the beginning of the quarter, again, how many units do you have already in inventory? Whatever is at the end of March, which is 5,000 units. So the 5,000 units at the end of the March goes at the beginning of the quarter, which is 5,000. So for the whole quarter, how many units you need to produce? 218,000 units only. Very good. Let's do one more problem. How about direct material budget? Okay, the 3 grams of musk oil are required for each bottle of mink Keres, a very popular perfume. Okay, the cost of musk oil is $1.50, okay, per gram. Budgeted production of mink Keres is given below by quarters for year 2 and for the first quarter of year 3. So we need to have a production budget. Remember, the production budget comes after sales budget, right? If you don't know your sales, then you don't know how much to produce. But if you know your sales, you know how much to produce. And if you know how much to produce, then you can easily make how much direct material budget you need. So the production is already given to us, which is good. We have it, production in bottles. The inventory of musk oil at the end of quarter must be equal to 20% of the following quarter's production needs. Some 36,000 grams of musk oil will be on hand to start the first quarter of year 2. Okay, so we already have 36,000 grams in starting of year 2. And we need 20%, at least 20% reserve at the end of each quarter. 20% of the next quarter should be at the end of each quarter. Okay. Using the Schedule 3 as your guide, prepare a direct material budget for musk oil. So let's do that. Here is the production units, 60,000, 90,000, 150,000, and fourth quarter, 100,000. Units of raw material needed per unit of finished goods is 3 grams. That comes somewhere from, it's right there. You see 3 grams of musk oil? Okay. So the 3 grams are required for each bottle. So we know that. Based on that, now we can go. So 60,000 units we are producing. 3 grams are required. So 60,000 times 3 grams, that means we need 180,000 grams of musk oil for the first quarter. Okay. Desired ending inventory raw material is already 20% in the inventory, right? 20%. So if we are required production is 60,000, 20% is, you know that you need 180, and you know 20% is already in reserve from previous quarter. So 20% of 180,000, that's the 36,000 that you have already in the inventory. Agree? And for the second quarter, we are producing 90,000 units times 3 grams. We need 270,000, right? 270,000. Let's calculate that. 270,000 times 20% reserve. That's 54,000, which is right there. So 54,000, that means 270 times 20%. We need. So we not only need 180, but we need 20% reserve of the next quarter, which is 54,000 grams. So total, we are looking at 234,000 grams, but 20% of first quarter production, which is 180 times 20%, already exists from the previous quarter. So that's the beginning of first quarter, year 2. That is 234 minus 36 existing. Then we need only 190,000 grams of purchase of the musk oil. $190,000 of purchase of musk oil times $1.50. That will cost us $297,000 raw material purchase. Make sense? So for the second quarter, we need 90,000 units times 3 grams. That's 270. Besides that, we need 20% of third quarter. So 450 times 20%, that's 90,000 grams reserve. So 270 plus 90,000 reserve, that's 360,000 grams. However, we have already from first quarter 54,000 as a reserve. Therefore, 360 minus 54, we only need to buy 306,000 times $1.50 each. That ends up to be 459. Make sense? So you continue the same process for the third and fourth quarter, and then add them up for the year. The only thing that, again, I want to mention, just to not get confused, at the beginning of year 2, quarter 1, how much do we have as a reserve? That's 20% off, which is the same number. You copy that. 20% off, 60 times 3 is 180. 180,000 grams times 20%. That's existing 36,000 already as a reserve. And that 36,000 goes at the beginning of the quarter. So be careful just on that one. Okay? Make sense? Let's do one more. How about that? One more. Okay, now let's talk about direct labor. So let's do that. No problem. Here we go. The production manager has submitted the following quarterly production forecast for the upcoming fiscal year. Remember, one more time, you need to have sales budget. After sales budget, you have production budget. After production budget, then you can create direct material budget, direct labor budget, manufacturing overhead budget. So here is the direct labor budget. Unit of production is 8,000 units. Quarter 1, 6,500 quarter 2, 7,000 quarter 3, and 7,500 quarter 4. Each unit requires 0.35 direct labor hours, and direct labor are paid at $15 per hour. Required. Using Schedule 4 as your guide, prepare the company's direct labor budget for the upcoming year. Okay, so let's do that. Here we go. Required production, we already have it. We know how much we are producing. Every unit of production takes 0.35 hour of direct labor. Ends up to be direct labor hours that we're gonna use. And we are paying them, let's say $15 an hour. This is maybe a little bit like old version of the solution. Imagine it's $12 per hour. So if it's $12 per hour, you multiply by 12. It is $15 per hour. You multiply by 15. Then you get your direct labor cost. Okay, and this is assuming that direct labor workforce is adjusted properly each quarter. Let's say the direct labor force is not adjusted each quarter and the overtime wages are paid. The direct labor budget is, so if we are going to pay overtime, what's going to happen? So if we have 8,000 units of production, quarter 1, quarter 2, 6,500, quarter 3, 7,000, and quarter 4, 7,500. We know every unit of production takes 0.35 hours. And that ends up to be 2,800 labor hours needed. And we know that regular hours paid is 2,600, no matter what, for each quarter, 2,600 hours. So if they work over 2,600 hours, and we are one of those companies that is going to pay for overtime, then you can see that overtime here is 200 hours. Okay, so 200 hours are overtime. And in quarter 4, 25 hours are overtime. So wages for regular hours, assuming if we are paying, let's say $12 per hour. So $12 per hour times 2,600, that's 31,200. 31,200, 31,200, 31,200, because we pay just for regular time. But for quarter one, if you are one of those companies who we pay like overtime, then 200 hours times $18 per hour, which is 1.5, right? That gives us $3,600 overtime. And here in quarter four, $450 overtime. Then you add them up, you will see that the company, the direct labor cost will be different because we are paying overtime. So when it gets adjusted each quarter, that means this, let's say in quarter two and quarter three, because we use less direct labor hours, we ask them to go home. That's why it says adjusted. But in some scenario, in companies that they pay overtime and it's not adjusted, so these people, even though they work less, but still they're gonna pay the guarantee income of $2,600 per quarter. So they're gonna get work less, but paid the same thing. That's why here we're gonna pay them $31,200 no matter what, because it's not adjusted. We don't have work, we let them stay and we pay them. But in quarter one and quarter four, we end up by paying them overtime. Make sense? Okay, so I solved some of those homework problems on chapter 8. Obviously, you have a few more that I like you to, use your book as a guidance and solve those homework problems all the way to the end. If you have any question, please let me know. Okay, I have office hours, don't forget that. Bye-bye.